If you've been investing lately, one thing that comes to mind is, when will our stock market rise? Our index, which is the PSEI, had an all-time high back in 2018 when it passed the 9,000 mark. Fast forward to 2022, we are still at the 6,400 range, meaning if you invested during that time, your money would be down negative 28%, though it's still better compared to the peak of the pandemic, wherein the index dropped by almost 50%. But it's been 2 years already, and yet we are still here, and we are still so far away from our previous high. So should I stop investing? Will the Philippine stock market recover again? What can I do if this goes on for a long time? So I will try my best to answer all of these questions, and I would also share with you guys what my strategy will be if eventually the stock market wouldn't move for a long time. Before we begin, it would really help out my channel if you smash the like button. And if you still aren't subscribed yet, be sure to hit the subscribe button as well so you won't miss out whenever I upload a new video. With that, let's first discuss why our stock market is like this. So the main reason why our market crashed in the first place is the COVID pandemic. With our economy at a standstill because of the lockdowns, this has affected most of the companies. Earnings were cut down hard, and as it goes, when there's bad news, this tends to make investors sell their stocks, dropping prices. And this went on for quite a while. Unlike in other countries wherein they lifted lockdowns quickly, for us it wasn't the case. Lockdowns went on and off, and this further restricted the movement of companies, slowing down their recovery. With that, our market trended sideways. Soon, the government did lift the lockdowns, allowing us investors to have a glimmer of hope, allowing our stock market to recover quite well, climbing to as high as 7,500. During these times, we thought we are on the verge of reaching the pre-pandemic mark, but another conflict has risen, the Russia-Ukraine war, which dropped the index below 7,000. To add to this, in the past months, inflation was another problem that further hindered our market to recover. So that's just about a quick summary of why the market is still lagging behind. So the main question here is, will our stock market ever recover? Or is the Philippine market going to experience what we call a lost decade? A lost decade refers to a period of slow to negative economic growth lasting almost 10 years. So if we put our state right now, our market had already been down for more than 2 years. If this goes on, let's say for another 8 years, then that's what we call a lost decade. Now this isn't something new in our market. We have already experienced it back in 1997. If you invested during that time, even after 5 years of investing, your portfolio would be at a massive negative. The only time our index exceeded its 1997 price was in 2007, giving you 1.21% annualized return per year, or a total of 12.81%. This means if you invested 100k, it would only be 112,780 even after 10 years. And this didn't just happen in our country, it happened in the US as well, and more so in Japan. In fact, they still haven't yet passed their highest point, which was in 1989. This downplays what happened in our index. And it doesn't end there. In 2008, the market crashed again, wiping out all your gain in an instant. Now, if you still had the motivation to hold on during these times, the only time the market fully recovered was in 2010. Imagine, even after 13 years, it only gave you 23.91% or 1.66% annualized return. So this is only like this if you didn't invest in between, wherein you just did a lump sum investment in 1997 and just left your money. Now, if you held on even more, the stock market would have gifted you with a lot of gains up to 2018, wherein we reached our all-time high of 9,078, giving you a 4.88% compounded return or a total return of 171.72% in those 21 years, making your 100k to 271,985 pesos. Not bad, and remember, this is just capital gains. This doesn't yet include dividends reinvested. So since we don't have any articles talking about this, let's just have a conservative estimation. Assuming you get 1% dividend yield average throughout those years, Now this is a very conservative percentage since our index's yield average around the 1.5 to 2.5% range. So if we add that 1% return and compound it for 21 years, that 271k a while ago would be around 331,000, giving us a total return of 231.97% compared to just 171.72%. This is quite a difference. Now why am I explaining all of this? Because since we know that this happened back then, we can assume it may happen again. No one knows, but it's good to be ready for it. We have to know what are the things we can do to maximize our returns. As mentioned, if you just did a lump sum investment in 1997, that's the only gains you will get. But what if we invested just once, assuming you invested another 100k, let's say in 2003? You know, the difference in your returns would be massive. Instead of getting 171.72%, your returns would then be 313.43%. Imagine the difference. And that is just a one-time investment in 2003. And this is still without dividends reinvested. So instead of just putting in a one-time investment, try to invest consistently in different time frames. Because let's face it, no one can time the market. No one knows when it will fall or rise. Sometimes, yes, you may be lucky when you invested at the very bottom, but that doesn't happen consistently for most of us. So be sure to combine the two to maximize returns, invest consistently, and have a longer time horizon. Instead of just waiting on the sidelines, don't try to time the market. Actually, there's a study to back this up. They showed 3 types of investors who invested in different time frames in an index fund in the USA. The first investor timed the market perfectly. It's as if he can see the future. And the second one just invested regularly every month, didn't care if the market is up or not. And the third investor was the unluckiest of all investors, always buying at the peak. So they started in 1986, and in the end year, all of them had a total investment of 105,000. Investor 1, who timed the market perfectly, made his 100k to 225,720. For investor 2, who just invested regularly, had 209,150. And for our last investor, had 200,538. Still close to the 2 investors. So what can we learn from here? You don't need to time the market perfectly. Even if you are the most unlucky investor, as long as you invest regularly in a long time horizon, not less than 10 years to be exact, you can still grow your money. Though this case studies for the US index, it's almost the same as what happened to us. The US index had the same market crash as our index. Now, another thing you can do to maximize returns is to reinvest dividends. Countless times I discuss in my channel that dividends play a big role in your overall returns. And since the market is trading sideways for a long time, in some years, dividends may be the only returns you will get. In a study made by Hartford Funds, they tracked the overall returns of the market from 1930s up to 2021. In some decades, like in the 1940s and 1970s, dividends takes up the majority of the returns by more than 70%. And just look at 1991 to 2000, dividends takes up all the returns for that decade. In total, from 1930 up to 2021, dividends take up 40% of your total returns. Now they showed another graph for this. In a 50-year time horizon, if you only relied on price appreciation alone, your $10,000 would only be worth $795,000. But if you reinvested back all the dividends received, your $10,000 would grow to almost $5 million. And to back this data up, we also have one for our country. This is the PSEI TRI, which accounts as well dividends received, and they compared it to the returns of the PSEI, which only relies on price appreciation. The starting value in 2008 for both funds is 1,000. Fast forward 10 years, the PSEI went up to at least the 2,000 mark, while the PSEI TRI, which had dividends reinvested, went up to the 2,700 level. This means if you invested 1 million pesos and didn't reinvest dividends, that would only grow to 2 million pesos. Compared to if you reinvest dividends, it would have grown to 2.7 million. Imagine a big difference in returns. And this is only in a 10-year time frame. Just imagine the difference 20, 30, or 40 years from now. So yes, it's tempting to spend the dividends you get, but try not to, because if it did, you are losing its compounding power. Though it may look small from a short-term point of view, On the grand scale of your investing life, it may take up most of your gains. So that's about how I will approach a lost decade. I would just continue what I've been doing. Since I invest in individual companies, I would invest in companies I know. I would reinvest every dividends I get. And since I'm focusing more on dividend-paying companies, I'm not afraid if the market stagnates for a long time, and it actually benefits me. Since the market is down right now, the dividend yield of companies increase because if stock prices go down, usually companies still pay out the same dividends and sometimes they even increase it. This means the cheaper you buy a company, the higher the dividend yield is. With the market trading sideways, this gives me more time to bulk up my portfolio with great companies that has good financials and good dividend yield at a much cheaper price. This is very beneficial for us investors who rely on our income monthly for our investments. This gives us more time. And technically, you aren't going to use the money 3 or 5 years from now. In fact, I don't plan to use my invested money even 20 years from now. I plan to stay in the market for as long as I can. So why would I be affected by a lost decade? And I'm even happy right now that I get to buy a lot of companies at a discount. To summarize things up, invest consistently, have a long time horizon, reinvest everything from capital gains down to the dividends. And the most important thing, don't panic every time your stocks drop. That's why it's really important to have a clear understanding of what you hold. And I didn't just explain past events without a reason, because history is there for us to learn from it, so that in the future, if we would experience the same thing again, then at least we would be prepared for it. With that, this ends this video for today. I hope you've learned something, and if you did and still haven't clicked the like button, then now is the time to do so. Thank you and see you in the next video.